I want you to picture a room. Like you are sitting right at this heavy mahogany conference table.
Oh, and the mood is just incredibly tense.
Yeah, exactly. To your left is the chief financial officer. To your right is the lead treasury specialist. And, this isn't a casual catch-up.
No, not at all.
This is a high-stakes strategy session inside a private equity-backed pharmaceutical manufacturing firm. Margins are razor thin. The investors are breathing down the executive team's necks. And, well, working capital is just everything.
It really is. I mean, in this room, liquidity isn't just some abstract metric on a corporate dashboard.
Right.
Liquidity is survival.
It's life or death for the company.
Completely. And that reality, it fundamentally shifts how you have to look at the business. Because the core thesis we're really dealing with today on this deep dive is that managing cash in this specific environment is absolutely not an accounting exercise.
It's not just moving numbers around.
Exactly. It is a relentless, unforgiving operational discipline. In a high-pressure, tight-margin scenario, your ability to forecast cash isn't just about keeping the lights on. It's the specific operational muscle that directly drives the long-term value of the entire enterprise.
Okay, let's unpack this. Because there is a very specific time frame that governs this entire world, right?
The 13 weeks.
13 weeks. I mean, that's the gold standard for private equity firms, turnaround consultants, lenders, everyone. But why that exact number? Like a quarter of a year feels a bit, I don't know, arbitrary if you're trying to survive week to week.
It does seem that way at first glance.
Yeah. Why not a rolling 12 weeks? Or just a clean monthly forecast?
Well, it's really all about finding this operational sweet spot. 13 weeks gives you exactly one fiscal quarter, which perfectly balances two entirely conflicting demands in corporate finance.
Okay, what's the first demand?
The first one is genuine accuracy. Like, you can realistically pick up the phone and figure out what a customer is going to do next Tuesday, right? But you absolutely cannot do that for a date 9 months from now. That's just guessing.
Right, the crystal ball gets a bit cloudy.
Exactly. But the second demand, though, is reaction time. 13 weeks gives the CFO and the executive team enough runway to actually do something about a looming disaster.
So if you see a cliff approaching in, say, week 10, you have time to actually steer the ship.
Precisely. Which is the exact opposite of how most companies operate, honestly.
Right, because a monthly forecast is what, too short?
It's effectively useless in a crisis. I mean, by the time the Treasury team realizes there's a massive cash shortfall in week 3 of a 4-week month, the cliff isn't just approaching.
You're already fallen off it.
You've already hit the ground. And then, on the other end of the spectrum, annual budgeting is just corporate fiction.
Corporate fiction, I like that.
Well, it is. An annual budget is a best guess document created in November that is entirely divorced from reality by the second week of March.
Which means the steering wheel is entirely based on cash, not revenue. And this is a massive reality check, I think.
It's huge.
Yeah, a lot of non-finance people. And honestly, even some business owners, they struggle with this foundational concept, which is that revenue does not equal cash.
And confusing the two is exactly how highly profitable companies end up in bankruptcy court.
Wow.
Seriously. A brilliant sales forecast is not going to cover your payroll. Let's walk through the mechanics of how this actually plays out.
Okay, lay it on me.
So your sales team lands a massive contract. They ship the product and issue the invoice on May 1st.
Great day for the sales team.
Amazing day. Under standard accrual accounting, your system recognizes that revenue right then, on May 1st. Your profit and loss statement for the month of May looks spectacular. The sales team hits their quota. The executives are absolutely thrilled.
But the company might still be completely broke.
Because the payment terms on that invoice dictate that the customer doesn't actually have to wire the funds until June 18th. So when does that money actually matter to the survival of the manufacturing plant?
June 18th.
It only matters on June 18th.
It's like looking at your salary on a shiny new job offer letter versus checking your actual bank app to see if your direct deposit cleared before you load a week's worth of groceries onto the checkout conveyor belt.
That is a phenomenal way to look at it.
Right. The offer letter is accrual accounting. Your actual bank balance right there in the checkout line, that's cash.
Exactly. What's fascinating here is that the goal of this entire 13-week forecast isn't to make sure the decimal points align perfectly for an external auditor at the end of the year.
It's not about making the math pretty.
No, the goal is operational cash accuracy. The people sitting in that mahogany room, they must know exactly when the cash physically hits the bank account and the exact hour it leaves.
Just to avoid breaching those liquidity thresholds.
Exactly.
So if timing is everything, the very first place we need to look is the money coming in. We have to figure out how these companies predict the wildly unpredictable nature of customer payments.
The inflow game.
Right. Collections are obviously the lifeblood of that game. I mean, you might have some tax refunds or asset sales, but customer cash is what keeps the engine running.
Bread and butter.
But traditional forecasting, it just assumes a net 30 invoice means the cash naturally arrives on day 30.
Which is a complete fantasy.
Right.
I mean, assuming customers pay on time is the fastest way to blow up a 13-week model. The only practice that actually holds up in a private equity environment is customer-level forecasting.
Okay, meaning what exactly?
Meaning you cannot forecast abstract blocks of revenue. You have to model actual human and organizational behavior at the individual customer level.
Wait, how deep does that go? Are we talking about stereotyping clients?
Well, you're building behavioral profiles, really. You don't just write down that you expect $2 million in week 3. You break the DNA of that number down.
Give me an example.
Sure. So you might forecast a $2 million payment from a massive distributor like Pfizer in week 3. Now, because it's Pfizer and their accounts payable department runs like a supercomputer, you tag that specific inflow with a high confidence rating.
Okay, that makes sense. They're reliable.
Right. But sitting right next to it in the forecast is a $250,000 payment from a mid-market regional client.
Oh, let me guess. The regional client likes to play games.
Oh, they play games, they dispute line items, they claim the invoice was routed to the wrong manager, they generally drag their feet.
Just a nightmare.
Yeah. So for that client, you tag the inflow with a low confidence rating. Or, honestly, you intentionally push the expected cash date out to week 5 in your model, regardless of what the official net 30 terms actually say.
But wait. If we're talking about a billion-dollar pharmaceutical manufacturing firm, why are they relying on humans to manually track individual behavioral quirks?
Good question.
Shouldn't their massive ERP software handle that automatically? Like, why can't a CFO just look at their accounts, receivable aging reports, find the historical average, say, clients usually pay 12 days late, and just apply a 12-day delay algorithm across the board?
Because averages lie.
Lie.
Yeah, they do. And in a tight liquidity environment, relying on a mathematical lie means you miss payroll.
Oof.
Granularity isn't just a preference, it is absolutely non-negotiable. To get true collection accuracy, the Treasury team can't just be finance nerds playing with formulas. They have to act like investigative journalists out on the floor.
Investigative journalists, what are they investigating?
The physical reality of the transaction.
Okay.
They have to ask incredibly specific operational questions to the sales and logistics teams, like, did the customer actually confirm they are scheduling the payment run? Is the invoice currently sitting in dispute because of a typo on the shipping manifest?
Oh, wow. So getting into the weeds.
Deep into the weeds. Was the physical shipment actually accepted at the client's loading dock, or is there an outstanding quality assurance issue?
Right, because if they rejected the delivery, they aren't paying.
Exactly. If a massive invoice is held up because a client's receiving manager didn't like the look of a shrink-wrapped pallet, your historical average of 12 days late is utterly useless.
That makes total sense. It's not a math problem, it's a reality problem.
Exactly.
Which brings up this really cool concept from the deep dive sources, probability-based cash.
Yes.
You aren't just making a binary yes or no guess on whether a payment will arrive. You are literally risk adjusting the actual dollars.
That's the secret sauce.
Right. So let's say you have a $1 million invoice due in week 2. But based on all that investigative work, maybe the purchase order was missing from their system earlier in the week. You determine there's an 80% probability of collection.
Okay.
So what actually goes into the 13-week forecast? $800,000.
That is the crucial mechanism. You only forecast the risk-adjusted cash. Because if you forecast the full million and you make purchasing decisions against that full million, and then only 800,000 shows up,
you are suddenly 200 grand in the hole.
Exactly. And that's how companies fail.
But mechanically, what happens to that missing $200,000? You don't just erase it from the ledger, right? Like, does it just vanish?
No. It rolls forward. And this is the beauty of the 13-week model. You push that 20% risk, the $200,000, into week 3 or maybe week 4.
Okay, I see.
You openly acknowledge the drag on your liquidity. The cash isn't gone, but it is delayed. And in this world, a delay is just as dangerous as a default if you have bills due on Friday.
And that is a terrifying transition point, honestly. Because if collections are the lifeblood, Disbursements, the money going out, are the bleed.
It's the scariest part.
Yeah, you need the cash in to pay the cash out.
Yeah.
Managing those outflows is where the tension in that mahogany room really hits the boiling point.
It turns into absolute triage. When liquidity tightens, you have to decide who gets the oxygen. And the absolute giant of outflow, the one category that is utterly non-negotiable,
Is payroll.
it's always payroll.
Missing payroll means the company effectively ceases to exist. I mean,
Yeah.
the factory floor stops, the trust is broken, it's just over.
Over. Instantly.
And forecasting payroll isn't just, copy-pasting last week's salaried numbers.
Far from it. Granular tracking is required here just as much as it is for collections.
Right.
You have salaried workers, yes, but on a manufacturing floor. You are tracking hourly overtime, shift differentials for the night crews, quarterly production bonuses, temporary labor for seasonal pushes.
Even severance packages sometimes.
Exactly. It fluctuates wildly week to week.
But after payroll, you get into vendor payments. And this brings up the harsh reality of tight liquidity. Like if I'm the treasury specialist sitting in that room, how am I prioritizing who gets paid when the well is practically dry?
You prioritize based entirely on operational continuity.
What does that mean in pharma?
Let's look specifically at the pharmaceutical manufacturing floor. You absolutely cannot delay payments to the suppliers making your active pharmaceutical ingredients. The API?
Because that's the actual medicine?
Right. Without that API, the factory stops. If you don't pay the API vendor, they stop shipping. If they stop shipping, you have no product. You also can't delay your packaging vendors or your logistics providers.
Oh, because even if you manufacture millions of dollars worth of perfect pills,
Yeah.
if you don't have the specific plastic bottles to put them in, or like the refrigerated trucks to ship them, you can't invoice the customer.
You're stuck.
And if you can't invoice, you can't collect cash.
Exactly.
Yeah.
Those are your critical Tier 1 vendors. You protect them at all costs.
So who loses out?
Well, to do that, you intentionally stretch the non-critical payables. The landscaping company, the office supply vendor, the marketing consultants.
Sorry, marketing consultants.
Yeah, they can wait an extra week or two. You use their cash to pay the API supplier.
Brutal, but necessary. But even with perfect triage, manufacturing has these incredibly unique, devastating risks that can destroy liquidity overnight. Let's walk through like a Friday afternoon nightmare scenario.
Oh, the batch failure.
Yeah.
This is the exact scenario that keeps CFOs awake at night. Imagine you've spent the cash on the API. You've paid the massive weekly payroll. You've paid for the machine runtime and the utilities. The product is totally finished.
Sounds good so far.
But then it hits quality control on Friday afternoon, and it fails testing. It doesn't meet the regulatory standard.
Oh, man. So all that cash went out.
And zero cash will come in. The entire batch has to be destroyed. You don't just lose the profit. You lose the actual cash you burned to make it. And now you have to scramble to find new cash to replace the raw materials and start all over again.
And if you don't have the cash buffer, the whole operation just grinds to a halt.
Yep.
The same thing happens with excess inventory, right? It's so counterintuitive because normally you think of inventory as an asset,
A lot of people do.
but excess inventory literally traps your liquidity. It takes your cash and turns it into a literal box sitting on a warehouse shelf doing nothing.
And in pharma, you are dealing with minimum order quantities. You can't just buy 1 barrel of a specialized chemical. The supplier forces you to buy 50. Combine that with strict regulatory expiry dates.
So a ticking clock.
Exactly. If you buy too much raw material to get a volume discount, but it expires before you can run it through the machines, you haven't saved money. You've quite literally incinerated cash.
Wow. We also can't ignore capital expenditures, or CapEx. We are talking about building clean rooms, installing new packaging lines, upgrading massive HVAC systems.
These are multi-million-dollar outlays.
Huge numbers. And what's crucial to understand here is that the cash timing for CapEx operates in a completely different universe than the accounting timing.
This trips up so many operators. You might be paying an HVAC contractor in massive cash installments in weeks 2, 6, and 10 to build the system. That completely drains your cash reserves in the present moment.
But on the accounting balance sheet,
That asset won't officially start depreciating until it's finished, which is months later. The cash leaves long before the accounting catches up.
so we have erratic collections, sacred payroll, demanding API vendors, and massive CapEx bills. How on earth does a CFO and a treasury team actually keep all these moving parts from colliding and crashing the company.
Well, they need an engine. And the heart of this entire discipline is the weekly variance analysis meeting.
Okay.
It is a non-negotiable ritual, and what's vital to understand is that it cannot just be the finance department sitting in a room talking to themselves.
Because if it's just finance, it's just an echo chamber.
Right.
Who else has to be at that table?
You need financial planning and analysis, FP&A, along with treasury, accounts payable, and accounts receivable. But crucially, you must have procurement, supply chain operations, and executive management.
Everyone.
Variance analysis is the ultimate accountability mechanism.
How does that actually work in practice, like week over week?
Every single week, week 1 drops off into the past, week 14 gets added to the horizon, and you look back at what you promised was going to happen last week versus what physically happened in the bank account.
You're checking your own work.
Exactly. You force the room to ask the hard questions. Why did our collections miss the forecast by $400,000? Why were payments to a logistics vendor suddenly accelerated without Treasury's approval?
Right.
Why did raw material purchases jump unexpectedly?
Listening to this, it sounds like forecasting isn't just a spreadsheet problem. It's a fundamental shift in company culture. Like, it's forced collaboration.
It has to be. The strongest finance teams treat cash forecasting as a cross-departmental operational process. Think about procurement.
Okay.
If a supply chain manager decides to take advantage of a sudden discount and buy 6 months of API upfront, they cannot just surprise the finance team with a massive invoice.
No way.
They have to communicate early because Treasury needs weeks of runway to ensure the liquidity is actually there to cover that opportunistic purchase.
And to manage this level of cross-departmental collaboration, the tech stack has to be incredibly robust. Let's dig into the tools actually running these 13-week models, because it's a fascinating mix. The foundation is usually an ERP system like SAP, right?
Yeah, SAP is your system of record. It's the vault. It holds the absolute truth, your purchase orders, your customer master files, your production schedules.
But SAP is rigid.
Very rigid.
It's brilliant at telling you what has happened and what is scheduled to happen, but you can't easily ask a massive ERP system, hey, what happens to our cash flow if our primary glass bottle supplier burns down tomorrow and we have to pay a 20% premium somewhere else?
Right. You need a sandbox. Which is why, despite companies spending literal millions on enterprise software, good old Excel remains the dominant tool for the actual 13-week model.
Crazy but true.
Excel gives the Treasury specialist the flexibility to build those complex what-if scenarios on the fly.
So you pull the data out of the vault.
Exactly.
Yeah.
You extract the reality from SAP and you model the future in Excel, and then you layer Power BI on top for the visualization.
Oh, for the dashboards.
Right. You need a cash dashboard showing the overall liquidity trend to the executives, a collections dashboard highlighting overdue invoices for the sales team, a payments dashboard tracking exposure for procurement.
This is how you translate rows of data into a reality that the private equity sponsors can instantly digest.
That's the game.
But the frontier of this is what really gets me going. We are seeing a massive shift toward using Python and data science libraries, like Pandas, Polars, and Scikit-learn. We're talking about moving from a human making investigative phone calls to using AI-assisted anomaly detection.
Oh, it's incredible. Imagine taking a decade of that raw SAP transaction data and feeding it into a Python machine learning model.
Okay.
Instead of relying on a human to notice that a client's payment behavior is slipping, the algorithm analyzes the subtle shifts.
Like what?
Maybe a client usually pays their invoices on Tuesday mornings, but over the last 3 months, they've slowly drifted to paying on Thursday afternoons.
That's subtle.
Very subtle. But the AI flags that deteriorating behavior before a human ever could, allowing the Treasury team to intervene and adjust the probability forecast weeks in advance.
Which perfectly sets up the ultimate why behind all of this stress. Why go through the agony of tracking every individual invoice, fighting over API payments in a mahogany room, and building machine learning algorithms?
Well, it all ties back to the private equity and lender mindset. Private equity firms buy companies to improve operational efficiency and sell them for a massive multiple.
Naturally.
And lenders just want to ensure they get their interest payments without drama. Both of these groups demand the 13-week process because it creates 3 specific things: confidence, predictability, and operational control.
It's about stripping the surprise out of the business.
Completely. They are laser-focused on free cash flow.
Right.
If a company has a robust, highly accurate 13-week cash forecasting process backed by a rigorous weekly variance analysis meeting that actually holds operations accountable. It demonstrates exceptional discipline.
And that discipline mathematically drives long-term enterprise value. Buyers will always pay a premium for a predictable machine. And for you listening, whether you're trying to keep a venture-backed startup afloat, managing a complex project budget, or just analyzing businesses you want to invest in, adopting this cash versus accrual mindset really changes everything.
It's a paradigm shift.
It is. An invoice is just a piece of paper. Cash in the bank is the only reality.
Yeah.
Tracking the precise, risk-adjusted timing of when things physically happen, rather than when you hope they happen, is the fundamental difference between thriving and scrambling to survive.
It is the ultimate truth serum for any operation. Which, leaves us with a final thought, building on that future state vision of Python and machine learning we just discussed.
Right.
If AI eventually reaches a point where it can flawlessly predict every single customer's late payment based on micro behaviors and instantly anticipate every supply chain delay in real time,
Oh, wow.
will the 13-week forecast as we know it become obsolete?
That is a wild thought.
Right.
Will corporate finance shift from a weekly, human-led meeting of executives arguing over spreadsheets to a second-by-second algorithmic cash manager that silently triages vendor payments in the background? When the algorithm becomes perfectly accurate, what is actually left for the CFO to decide?
A fascinating place to leave it, something to really think about. Thank you so much for joining us at the table today and for coming along on this deep dive. We'll see you next time.